the next structure, the villages, which is basically a $12 million structure. To kick things off, I wanted to give you some background on HOAs and insurance. By law, all HOA boards and HOAs are required to have certain types of insurance at certain amounts. For our HOA, for Oak Tree HOA, the general requirements from Article 9 of our declaration, and the declaration is the governing document that has the highest authority. Things like your covenants and restrictions, your bylaws, your rules and regulations are all subservient to the declaration. In Article 9, it says that we have to have, as an HOA, $2 million in general public liability coverage, and we do carry that. We have to hold $3 million in an umbrella policy, and we do carry that. All of our insurers, which the broker goes out and finds for us, and again, all of our insurance coverages are mostly from different companies, because different companies specialize in different types of insurance. Our declaration states that they basically must be A-rated or better. In insurance ratings, you can have A, double A, triple A, things like that. They have to be A or better, and we have that. We have to carry $1 million in directors and officers insurance, which covers all former, present, and future board members, all directors, and all of our committee members as well, former, present, and future. There is no legal requirement for flood insurance, and we do not carry that. And there is no legal statute for us to hold earthquake insurance. But currently, we do hold earthquake insurance, and only for the past year on the pavilion. So that's what we're talking about today. Our declaration also states that any damage to the common area in the event of an earthquake or any other reason shall be repaired or reconstructed unless 75% of the ownership decide within 60 days after the loss not to repair or reconstruct it. Or you can choose to construct an alternative improvement. Again, it must be reconstructed or repaired unless 75% of the ownership states within 60 days not to do so. And the scariest thing that I found in the declaration that I hope we never have to face is that if insurance proceeds are insufficient to pay for repairing or constructing or reconstructing the damage to any common area, the board may, without the vote of the members, levy special assessments to pay for such repairs or reconstruction against the owners. I state that because everybody had the question of, would we even rebuild? Or, if it was a really bad volcanic earthquake, our own homes might be beyond repair. Maybe everybody would just get up and leave if you could. So I found that paragraph and I thought it was important. Before turning this over to Ryan, I'm going to also point out that our insurance premiums just in the past year rose $8,000 or nearly 30% in just the last year for the exact same amount of coverage. And Ryan's going to address some of that and why, and the fact that insurance rates are going up nationwide. So Ryan, all up to you, and then we'll open it up for questions as we go, okay?
Okay. So so great recap. So I'm Ryan, I'm with the Partners Group, and I focus on insuring associations and providing all of the coverage that you buy as an association. And you do have multiple policies for all of the different categories. And the reason that you have multiple policies for all of these separate categories, like property and liability, directors and officers, crime coverage, umbrella coverage, earthquake coverage, is because different insurance companies specialize at different different exact line items of coverage. So a lot of insurance companies, while they will provide coverage in the majority of the categories, they're not necessarily the best. They don't necessarily provide the best coverage when you try to condense it all down onto one policy. So you actually get better coverage at a lower cost when you put all of these specific individual coverages with the insurance companies or programs that like that coverage the best. So by breaking it up, you tend to get a full-blown policy with best-in-class coverage at the best price. So the overall look and feel of your insurance program is very similar to last year. It is more expensive, and part of that increase in cost is because your unit count went up. So as you grow as an association and have more units, then the cost will get incrementally larger because it charges you on a per unit basis. And I think you have about 350, like a year ago, we had 260 units. Now we're up to 350, and at full build out, you'll be at around 814. So as you grow, your cost will grow, but your cost will also get spread over more unit owners. So I guess for property, I'll kind of start at the top of my list. Property coverage, we insure your common elements. And the common elements often come from your reserve study. So you'll have all of the common element features, which will also include the clubhouse. And if you add another clubhouse, we would insure that clubhouse. So that is all property. And then as part of your property coverage, we tend to group general liability onto that same policy. So you have a package policy that provides both property and general liability. That tends to be very common. General liability is, think of it as somebody else is injured. Actually, it could be an owner even. Could be an owner, could be a guest, could be an uninvited guest. Somebody typically is either injured or harmed. And it could have been a trip and fall on a sidewalk. It could be a slip and fall in the clubhouse or any common area. And now that injured party is looking to the association to be made whole, or they want money. So then your general liability is the coverage that is protecting the association from any type of third party bodily injury or property damage claim against the association. And now your general liability is defending you and paying for that loss if you're found responsible for paying for this loss. So property, general liability, we tend to put on one policy as a package. As you grow and you have larger clubhouse exposures, I might actually break up those two policies and put them on separate policies, because I might find that I can get better property coverage from a property market, but that same property market isn't a fan of larger general liability exposure. So as you grow, your insurance program will most likely evolve, and I'll put the coverage with the best markets based on your exposure at the time. Another liability coverage that you have as an association is called directors and officers. So while the general liability coverage pays for bodily injury and third-party property damage type coverage protecting the association, you all vote for a board. So you vote and you have a board and you have committees. And so this board making decisions on behalf of all owners it creates a financial impact. So the board making financial decisions on behalf of all owners creates a liability for both the association and the board members individually for decisions you make while running the board and making decisions on behalf of all of the unit owners or all of the owners. And so if an owner doesn't like the decisions that are being made or feels like there's financial harm from something that has happened, that's why you have this directors and officers policy to protect both the association and the board members personally and individually for all of these decisions that are being made. In addition to the next line item of coverage is umbrella. And so umbrella is just like a personal umbrella. Umbrella coverage is a line item of coverage that is providing higher limits of liability. So on your primary general liability policy, you have a $1 million limit of coverage. And it actually gives you unlimited defense. So say it's, somebody's on a sidewalk or in clubhouse area and there's a trip and fall and it's a broken hip or cracked elbow or, a broken knee or whatever, but somebody's injured and now they're suing and they want $2 million, which is super common. And so your primary general liability policy says we will protect and defend you with unlimited defense expense. And then if the association is found responsible and needs to pay out settlement, then your general liability policy has a $1 million settlement limit. The umbrella then sits on top of this $1 million and bumps that up by 3 million. So now you have $4 million of potential settlement dollars that can get paid out from a liability loss.
Ryan, before we go on to crime and employee theft coverage, if we could just go back for a second to the idea that our insurance costs go up as more units come into the community.
Mm-hmm.
I know that was hard for me to wrap my head around originally when I was dealing with a couple of the insurance quotes over the past couple of years,
Mm-hmm.
because we don't insure individual units.
Correct.
So it's natural to think, why would our insurance go up if we're not insuring each new home as it comes in? But as I look at it from an insurer's point of view, it's more people using the common facilities. It's more footsteps in each clubhouse. It's more more people diving into the swimming pool that's coming up, etc.
Yep.
So it's a matter of increased usage by the population increasing more than it is the increased number of units, because we're not actually insuring those units. So do I have that right?
That's totally correct. Yep. And
okay.
in the insurance world, that's their rating basis. So as a function to help determine what is our exposure, you're spot on. As there are more owners bring more foot traffic, and more foot traffic brings more risk of liability. And I would tell you the reality is the most common issue is probably going to be a trip and fall, because you will have a lot of common areas and sidewalks and walking trails and people trip and fall. So as you grow, the reality is the most common issue with general liability is people trip and fall. So
great, thanks. And for everybody else, if you open up your chat, if you have any questions, you can start typing them in and we can address them. We can even call on you later. Go ahead, Ryan.
Okay, so the next segment of coverage that you have is what we call crime coverage. And crime coverage is also, it can also be referred to as employee dishonesty, or it can be referred to as fidelity coverage. It's just 3 different words or 3 different lingo, but it all means the same thing. And ultimately, you are buying insurance that is protecting your money, because as an association, you pay dues, and part of your dues go to savings and a reserve account. And so you're saving money, and you will be building up a slush account of money. And so this is the line item of coverage that is protecting your money from theft. So in case, a board member figures out, a board member, a committee member, a property management company, it's a very broad policy, and it's designed to protect your money from theft, essentially from anybody that has access to your account. So, and the rule of thumb is you tend to buy a limit of coverage that is equal to all of your money, so you say what do we have in savings, checking, CDs, all of our cash accounts, plus 3 months worth of dues. And that tends to be what the lenders require. But kind of as a general idea, it's if somebody takes all of your money and then they continue taking money for 3 months, eventually you're going to run out. So the banks use that formula as a method, thinking that they've captured what could be your maximum out of pocket. And so as you fund every year, we will probably increase that limit. And as you have large capital expenditures, we might decrease the limit. So we just sort of take a snapshot around renewal time, and then we increase or decrease the limit as you need. The last item of coverage is earthquake. And earthquake is by default always excluded from every package policy. And it's excluded here in Pacific Northwest because it's not a matter of if we will have an earthquake, it's when the next earthquake hits, and we don't know how bad it will be. So all insurance companies exclude earthquake coverage, and if you want earthquake coverage, you buy it back specifically for earthquake. With earthquake, there's a little caveat. If there's a fire, or so if there's an earthquake and the earthquake causes a fire following an earthquake is actually covered by the package policy. It's a little carve back that that's not actually on the earthquake policy, but it could, if the earthquake results in a fire and the building burns down, then the coverage is actually on your package policy. But if the earthquake just rattles the building and creates a bunch of water damage, then water damage is actually part of an earthquake policy, so you would have to have earthquake coverage. But it is optional. Yeah.
We do have a couple
Okay,
questions
so
about
one
that.
of the, yeah, exactly. One of the questions coming in is the deductible.
Mhm.
And everybody, that is pretty standard across the board. In my experience from my own home and other homes I've owned, the deductible is 20%. Is that right, Ryan?
So with personal insurance, I would tell you that is very common and correct. With commercial insurance, which as an association, you're really buying commercial insurance policies. The more common deductibles for earthquake coverage on commercial policies tend to be 5% or 10%. And so your deductible is 10%. And
okay.
And anytime and with all earthquake policies, the percentage deductible is always a percentage of the scheduled building value. So it's not a percentage, it's never a percentage of the amount of damage. It's always a percentage of whatever we schedule the actual value of the building for. So like we schedule a building of 3.6 million at 10%, it's basically $360,000. So if there's an earthquake, we would look at it and we would say 10% deductible, it's 360,000. Does the earthquake damage exceed that amount? Yes or no? And if the answer is yes, it's over that amount, then we file a claim on the earthquake policy. But if no, it's under that amount, then we don't file a claim. But either way, as an association, you would say, okay, we know we have this deductible, and we know we would have to then assess all owners. And so you can kind of budget, hey, what would my assessed amount of this $360,000 deductible be? And you can easily calculate that. And then as an owner, you can actually buy personal earthquake insurance. And so if you say, well, I want earthquake insurance for myself personally on my own home and my own contents, you can actually include a feature called earthquake loss assessment on your own personal insurance. So if the association assesses you personally for the deductible, you're buying your personal earthquake coverage can pay for that assessment, which is kind of a cool feature.
Okay, Ryan, I'm going to ask two people to unmute. First, Smitty had a question. I want to make sure that anything that you said is fully clarified. And if not, Smitty, do you have any more you want to ask?
No, that explanation pretty much took care of it. I was interested in what that deductible would look like and how it was going to be qualified or calculated. But because like in our homes, they're a certain amount when they're bought, but then they appreciate or depreciate. And so that was going to be the flexibility that I was interested in. So thank you, I'm taken care of.
Yeah, and it would be the same. So typically on your personal insurance, whatever value you see, that percentage is typically applied towards the scheduled value on your policy.
And William Dickey had some more questions for clarification.
Thanks, Steve. So Ryan, so the association has, we're going to soon have multiple facilities. We're going to have the pavilion. We're going to have the main clubhouse. We also have infrastructure in the community, like sidewalks and lights and all those items.
Yep.
So, if you look at those as really kind of different assets that are being insured, if an earthquake happens and, there's damage on one of the assets, but not the others, is the policy one giant, all encompassing? So if, I'm just going to throw out simple numbers for simple math here. Yeah. Let's say that the policy is overarching, $10 million of coverage.
Yep.
So the deductible would be 1 million.
Yep.
If the damage is on, is just on, so our new big clubhouse, if there's, if I hopefully you know where I'm going with this.
Yeah, I do.
Are we going to end up with one piece, with a larger deductible because we're trying to cover everything, where if it was in smaller pieces, we might actually, pop over a deductible limit and be able to get some coverage? Does my question make sense?
Oh, yeah.
Trying to head with that?
It does. I can expand on that. So on the earthquake policy, we actually schedule each individual building. So you might have one building that's 3.5 million and another building that's 5 million or 10 million. And then in addition to those, we also schedule coverage for paved surfaces, which could be, you might own private streets or sidewalks. So we have surfaces. We also have some underground utilities, because once the utility leaves the street and it enters your property, you own the utility. And so in an earthquake, that could be damaged. So we schedule all of these items, and logically think of it as a list. So you kind of have this laundry list of building 1, building 2, building 3, paved surfaces, underground equipment, underground infrastructure, or we call it underground utilities, paved surfaces. You might have contents. So you have this whole list of items. And so you can write an earthquake policy to where the deductible applies against the entire list of scheduled value, which means your deductible is very high. And I would tell you, I never structure the policies that way because I don't like it. Perfect. We always structure our earthquake policies so the deductible will apply towards each individual building. So it's building 1, building 2, towards each separate item. That way, if there's a loss and only, the one clubhouse is damaged, the deductible only applies towards the one building that was damaged and that specific value that is scheduled on the policy. Does that answer your question?
It does. It does. And thank you. I was concerned about, if we're looking at the whole, that it would be tougher to meet that deductible.
Yeah.
And so that is great that that's the way you write the policy.
Yep. And that is one of these things, like I always try to remind people that I get it. Insurance it's this big expense. It's confusing, and it's something that you kind of hope, gosh, I hope we never have to use it. So we pay all of this money for a bunch of words on pieces of paper that we hope we never have to use. You know?
Right.
So, but I always try to remind everybody that insurance is not just this expense where you're trying to say, I need the cheapest thing possible. Because when you have a loss, the only thing that these insurance companies have to go back on are these words on a piece of paper. And ultimately, it's a contract. So you have to make sure that this contract is providing coverage for what you expect it to cover. So there's a lot of, I try to remind people of this all the time because because common sense says, how do I get the cheapest premium possible? I always look at it from the perspective of, you have to start with the coverage. You have to get the coverage right first, because if you don't have the coverage right, the cheapest premium doesn't matter. Because if it doesn't cover what you expect it to cover, you're just going to be unhappy. So insurance is not all the same. It is very different. And so that's how I operate. I want everybody to be happy when there's a loss and make sure that there's coverage. So
Happy when there's a loss. Boy, that's a tough sell, but okay.
I know.
I get what you mean. Okay, so Ryan, it is very tempting not to carry earthquake insurance, because once we add this second clubhouse, our current earthquake insurance accounts for $4,000 of the $31,000 annual premium.
Yeah.
When we add the second clubhouse, it's easy to see that the earthquake insurance premium alone will rise to between $16,000 and $20,000 per year to cover $16 million worth of combined clubhouse assets, not to even mention things like 200 street lamps and a bunch of privately owned alleys and all that kind of stuff.
Yeah.
So my question to you is, I imagine you have a lot of, or at least a handful of HOAs as clients, correct?
Yep. I have about 1,000.
Oh, wow, my God. So what is the commonality of HOAs securing earthquake insurance in the West Coast Ring of Fire, 30 to 50 miles away from a active yet dormant volcano? How often do you get HOAs to sign on to earthquake insurance?
So I kind of break it down. So I would say in my world, of the 1,000 associations that I have, it's kind of it's about a 50-50 split, where about half of them are condo associations. Actually, it's probably 60-40. Probably like 60% are condo associations and 40% are homeowners associations. On the condo associations, I would tell you about 80% of them buy earthquake coverage, because from a condo association perspective, they are insuring the buildings. So they have large building values. They're worried about the buildings and the infrastructure. 80% of them buy earthquake coverage. On the HOA side, there's a huge range. There's a lot of really small HOAs that don't have very much infrastructure or common elements. Some of them have little to very little infrastructure. And then the larger associations, like yourself, as you're getting larger, you have a lot of infrastructure. And I don't keep exact metrics, but when I'm just running through my brain of who buys what, I would tell you the smaller ones that do not have infrastructure values, or a lot, tend to not buy earthquake insurance. The larger associations that do have more infrastructure tend to buy earthquake insurance. So I would probably say if you have larger like clubhouses and larger values, it's probably similar, like 80% probably by earthquake, similar to the condo side.
Mm-hmm. Okay, does anybody else have any questions for Ryan or the board? If not, can I just hear from people as to, you know, if you were in full authority, you know, a dictator of the HOA, would you secure this earthquake insurance for the group, or would you not? And why or why not?
Okay, I'll jump in.
Thank you.
I haven't been here very long, only since, well, I moved in 21. But the one thing about earthquakes is that it's not like a tornado or a hurricane where you're going to get damage at a certain wind speed or, you know, flood level that you can predict. We have had just in the last year multiple small earthquakes that you may or may not have felt and that may or may not have caused damage. And so the one thing that I worry about, I mean, we had the Nisqually one about what, 20 years ago or so.
2000.
And so to me, as we continue to build this out, I see it as an expense to not just protect ourselves, but to protect what we are building here and make an investment in that. So that if something does happen, even if it's something small, we know we can get it fixed. And you know, hopefully there won't be any, like Steve pointed out, you know, something that a board has to take action on and surprise everybody with an assessment. And so I just see it as a good investment overall. I hope to die here someday. So I want to make sure that as we continue to build this lovely neighborhood, that we protect it, because we know that the city isn't, we know that the county can only do so much. And so the rest of it really does fall on us. And that's just how I see it. So I think it's a good investment either way. And as we get more people in here, those costs, like a lot of other things, will be spread amongst all kinds of people. And just to, we were talking about the 360,000 earlier. I divided that 360,000 just as a quick math thing over like the 800 homes that we would eventually have. And that comes to $436. So, you know, a lot of these things I think could be handled. But again, I see it as a total investment. So I think it's worth it from my corner of the world. Thank you.
Yeah, the 360,000 would account for 10% of the value of the villages, but you'd have to look more along the lines of 1.6 million for 10% of the value of the combined clubhouses coming up.
When it's fully built out.
Yeah,
Right.
Well,
but it's
not-
yeah, whichever was damaged. Yeah.
Yeah.
So again.
Right. Anybody else, pro or con, or why?
Hi, I'm Dave.
Hi, Dave.
We were looking into earthquake insurance when we moved in a few months ago, and it came back sort of a surprising amount, 11 or 1,200 bucks a year.
Really?
Yeah, and then the deductibles said, "Wow, we have to have a lot of damage before they start kicking in."
Mm-hmm.
It's sort of like most of the earthquake, and I've lived in the Northwest for a long time. I've been through several earthquakes that damaged things. Most people's damage was fairly slight compared to what I would say is a catastrophic, the one they're talking about, the 10 on the Richter scale off the coast. And if that happens and you have to really start taking advantage of earthquake insurance coverage, I kind of wonder, is anybody going to want to move back into an area that's been devastated by an earthquake? So I'm not, it's not as easy for me to come up with an answer that's lickety split. You know, there's the money is substantial, and if you have a lot of substantial damage, is it going to be able to be repairable? You know, is it going to come out, and is it going to look like a place that people would want to move back into, or just be like Alaska? And I remember that one. So that you wouldn't want to be caught in something like that, no matter how much earthquake insurance, the land's pretty much devastated. So I don't know. I offer no, yes or no.
Well, your yes or no, I've been asking this question in my office hours and in conversations and community walks with people for about a year now. And I would say it's split down the middle 50-50, or if there is a majority, the majority is people going like this, I can see the benefit of it and I can see not doing it. And that's sort of where we're at. Anybody else? Well, while you're thinking about chiming in, by a show of hands, raise your hand if you cover your own house or you'd like to cover your own house for earthquake insurance. And look at that. It's, it's pretty 50-50 again. Damn it. I just keep getting 50-50s. All right. Is there anybody else who would like to have a question or chime in?
Steve, I got a question. Okay, on my homeowner's insurance and my earthquake insurance, they cover our personal home and stuff, but they also have a little clause for outbuildings and stuff. Does that insurance, could that be used to cover our HOA buildings?
It's only
know?
if you only on your property if you own it.
Okay, but we do own the HOA, the stuff, don't we? I mean,
But
the
not-
buildings.
The clubhouses can't really be considered outbuildings. They're the buildings in and of themselves. The outbuildings to the clubhouse would be the storage shed, the bocce ball storage, the pickleball storage. We can't think of the $12 million Villages building as an outbuilding. It is the building itself, and it has outbuildings associated with it. That's where I think the distinction is.
And it comes down to the insurable interest in the structure. So like personally, you have the insurable interest in your home, your plot of land, but the clubhouse and the common element structure that sits on common element land, the association has the insurable interest. So if you want coverage on those buildings that are common element that sit on common property, then the association has to buy the coverage at the association level.
Okay, thank you.
Yeah.
So Bill Smiley, how'd you get to the $2 a month at full build out? Tell us about your math. You might be right. I'm just asking how you got to it.
By the way, Mariners will win 91 games this year, but I'm not too sure. Well, you said it's $20,000 a year divided by, I just said 800 homes.
Sure.
By 12, and it came down to like $25 a year, $2 a month. So yeah, we all want to know, okay, so if we go ahead and purchase the earthquake insurance, how's it going to affect our bottom line?
Okay, that's great.
Yeah, your math is about right.
Is that about right? Okay.
Yeah.
So the sidewalks, the irrigation systems, we do have an earthquake. Not only do we have to fix our own homes, but we would have to fix the sidewalks out front, irrigation systems for the plants, common areas.
Yeah.
Well, actually, sidewalks here are considered right of way in Thurston County.
Yeah, I was gonna
Yeah.
say so typically with sidewalks, you have the duty to maintain. So which typically means clean. But then if there's repairs that are needed, like if there's concrete that's, elevated or chipped or cracked or it's a tripping hazard, you tell the city, and as soon as you tell the city, it puts the responsibility on the city. And if they don't repair it, then they're negligent. And if somebody trips and falls, the trip and fall will fall on the city's insurance. So you'll notice that the cities are pretty quick to get out there and grind down concrete, repair concrete, because they want to eliminate the tripping hazard. But the owner that is adjacent to the sidewalk typically has the duty to maintain and keep the sidewalk clean and free of hazards. But when it comes to repair, it's often back on the city for the sidewalks. It would be different if you have private roads, then it could fall on the association, which is called like
private.
Yeah, I was gonna say, Jennifer.
We have a few private tracks in the community where that would apply.
Yeah. So we schedule some paved surfaces coverage for that type of stuff.
Okay, Ryan, well, go ahead, Bill.
Okay, so if we go ahead and decide to purchase earthquake insurance, do we have funds to cover that now, or are we gonna be looking at increasing the HOA association fees?
Right, no, we have funds to cover that now, but we would add in the $2 a month at full build out, or the more like $5 a month per person presently into the budgeting cycle. So in fact, I think we already did for this budgeting cycle. We had planned on doing earthquake insurance. So I think it's budgeted for, if I remember correctly. I'm pretty confident in that. So all we get out of this is a savings of about $16,000 a year. Ryan, I wanted to help out Linda and Dave. They're paying that or getting that quote of $1,100 to $1,200 a year for their own home. That sounded pretty high to me. I think I get my home covered with a 20% deductible at something along the lines of $400 a year, and I have the largest model in the community. So just helping out another homeowner here, Ryan, $1,200 or $1,100 a year for earthquake insurance for a private home sounds pretty high. What do you think?
So I would say whatever you pay, if you do not buy earthquake insurance, whatever you pay for your homeowner's policy, earthquake tends to double that cost.
That was about right.
Yeah.
We started, I'll just be upfront, $1,200 a year for homeowners, and it was a $500 deductible, and we had a few riders.
Yeah.
And here it is 1 year later, and we just got a quote. It's $700 higher than that.
Yeah,
I'm actually looking for something a little bit better than that. Ryan, do you take on individuals?
We have a whole department that does personal insurance. So if you need help, you can reach out, and I can connect you with our personal lines folks, and they can pull quotes. But I would tell you, even my own personal, and when I go to our company meetings and our personal lines people have been talking, they've basically said that all personal lines insurance is probably going up like 25% right now.
Yeah, well, that was more like 55, 60%. And
Okay.
they started talking to me about all of the claims they've had all over the US. And I said, yeah, but I live in Washington.
Yeah, it's because when insurance companies sell you a policy, behind the scenes, every insurance company turns around and they buy reinsurance.
Yeah.
And it's those reinsurers that have been paying all these losses all over the world. Yeah. And they're coming, it's hitting everybody.
Well, I promise not to build my house on the ocean front.
In a floodplain, right?
Yeah, I promise not to do that, you know.
Yeah.
Ryan, it's a bit of a personal issue for me, but you can imagine committee members and board members sometimes have a hard time getting homeowners to realize that costs go up across the board in many things. Mm-hmm. Now, you did address the fact that as we add more units into the community, our insurance goes up. But isn't it true that we've seen statewide and nationwide insurance rates rising higher the past 24 months than historically?
Totally. Yeah.
Okay.
Yep. And the reason is more claims, more litigation, and cost of construction and repairs are through the roof. And so I would tell you, from what I see, pretty much everything is underinsured. And when the losses happen, they are significantly higher than what the insurance companies have been insuring stuff at. And so they're paying out way more in claims than they anticipated and modeled. And so they're all struggling. And so it's a combination of rate increases and building value increases. So,
yeah. Good. Well, Jennifer, my board president, I see her smiling and snickering over there. I'm going to turn it over to her, see if there's anything left. And go ahead, Jennifer.
I didn't know I was snickering, but I was smiling because we did an evaluation. We realized we weren't exactly fully covered. about a year or so ago. Actually, Steve caught it. And we did do an evaluation of the pavilion in anticipation of the delivery of the villages coming up. So we are fully covered. We have adequate, appropriate coverage. So I just want people to know that. We are not in a situation where we're under insuring at least the current amenities and common areas that we have within our community. And I'm going to thank Steve for kind of actually digging into that and sort of discovering that we needed to increase our coverages. So that was a good catch on his behalf. Yeah, this has been great. This has been informative, and I think this has been educational for all. If you want to share with us the line for personal, we're more than happy to share that for the owners that may want to be interested in looking into that for themselves. You can shoot that over an email and we can get that out to the ownership.
I was gonna say, it might just be easy, just share my contact information and then anybody that pings me, I'll just connect you with our personal lines people and they can totally help.
Perfect.
And then it's simple, it's just one point, it's just one contact.
Sounds good, easy. Someone's asking in the chat, so what is next? That is a great question.
Yeah, Bill, it's tough. It is a bit of a gamble. So, Bill, you talk about the homeowner burden being $2 a month once it full build out, and it's more expensive on the each homeowner while we're at a smaller amount. But the flip side to that is if we had an earthquake before build out, the burden on the fewer homeowners to rebuild is so much larger. So perhaps the best time to carry earthquake insurance is now. For if the catastrophe happened, we'd have to spread the $16 million across the 350 or 400 or 450 homes wherever we are in the timeline, 800, and it'd be much more painful. So perhaps the best thing to do is to carry, if you're going to carry earthquake insurance and cancel it at some time, it's probably best to carry it now while we don't have as many homeowners to account for the recovery. Yeah. So I'd say I'm leaning toward continuing to cover it.
Well, is this something that you need to present to the homeowners? I mean, that's where I'm at. What is next?
So what is next? Because I'll double check. I believe it's already budgeted for the year. We're perfectly fine to go ahead and get the coverage. It's just a question of whether or not we want to save money and not get the coverage. So there's no more input is needed from the homeowners is required. I mean, as it goes to a vote or something. This is the input we're looking for with the last board meeting and this presentation. I haven't heard anybody with a very strong argument against. Yes.
Steve, I have a question for Ryan.
Sure.
When we're looking at specifically earthquake insurance, what is the data for damage to newer or newly built construction? Because I'm thinking back to I'm born and raised in the Pacific Northwest, and I've lived through these earthquakes, and the amount of damage has always been to older structures, things built on less solid ground. So is there data to say, just even back to the Nisqually earthquake, because all I saw was damage downtown Olympia to the older buildings, the bridges. None of the schools in the school districts had damage. None of the houses that were newer or new construction had damage. This is all newly built, and it's built up to earthquake code. So that's my question.
So, and the answer to that is the older buildings definitely tend to get hit the hardest. And so because your buildings are newer and they're built to the latest earthquake code, the answer is your premium is very inexpensive in comparison to the older buildings. So basically your current premium is about, everything is on a cost per 100 of value. So your cost is like 11 or 12 cents per $100 of value, basically. But for buildings that are older, And when I say older, it's really like there's kind of a range, like down to your, like you would have your rate back to like if you were built in year 2000. And then if you're built from 2000 down to 1980, it's a little bit more expensive. And then from like 1980 to 1970, it's a little bit more expensive. And then older than 1970, your rate goes up quite a bit, because it was like 1968 when they started making everybody strap the structure to the foundation with like the earthquake strapping. And so prior to 1968, the rates tend to go up quite a bit. So it could easily be kind of started out at like 30 cents. So 30 cents per $100, or in, you know, in relation to what you're paying, call it like 3 times what you're paying if your same exact building was built in 1970 or older. You know, it could easily be 3 times as expensive. So you get a significantly lower cost because you're new, and you're new. It's wood, your wood frame, and you're built with the latest earthquake codes. So everybody knows that you will rattle and roll. You shouldn't shake off the foundation. They expect some minor damage, but they don't expect a total loss. They expect a partial loss. And it's definitely, they expect a smaller loss than if the buildings are older. So because of your age built, structure type, you're getting best in class of rates. That's the answer.
Thank you.
Yeah.
Yeah, I kind of
Good
want
question.
to add a little bit. The actual cost of the earthquake insurance, even at almost the same as my homeowner's insurance, is, you know, not so bad. But when I started looking at the deductible, I'd have to have at least $36,000 of damage before anything would kick in.
On your
And
personal.
I've not seen that much as woman was Iria. I can't pronounce your name, but yeah, when you look around at what's happened in the past, the damages isn't that much. So I have a sort of a third concern here. Do we have a fund available that's going to cover the damage that isn't covered because it's too low? It doesn't reach the deductible level. And if you're talking a $60 million building, how much damage does it have before anything kicks in? Well, we still have to repair the building if it doesn't kick in.
Yeah, so Ryan
Yeah.
talked about it as a slush fund, and my hackles went up my back and I cringed. What he meant to say was reserve account. Nope, we don't have a slush fund, folks. We're not going out and buying, you know, candies or whatever. So the reserve account is earmarked for certain things when you look at the reserve study.
Right.
But that money would also be eligible for something like covering the deductible or the damage that didn't come up to the level of a deductible in the case of fire, broken windows, earthquakes, stuff like that. So yeah, that's the purpose of the reserve fund. While the reserve fund is only sitting around 360,000, only sitting at $360,000 right now, within 10 years time, we're required to have the reserve fund up to, I think it's, basically it's $1.5 million. So the reserve fund grows with the community to cover things like that. I'm just going to finish up. Yes, go ahead.
There was another part of Dave's question that I think you asked, if I heard correctly, would we even rebuild? I believe there's in the back of our CCNRs, there's a section of obligation of deciding what to do in a case of an event. So I'd have to go back and look in the CCNRs, because I think you have to vote on whether or not the association chooses not to say rebuild a clubhouse. Yeah,
Right,
so
and as I started in the meeting, it's in the declaration that 75% of the ownership would have to say no to rebuilding, otherwise we rebuild. It has to be done within 60 days of the damage. Tom, is it Splaver? Tom, you there? Well, Tom put in a great question, and we got to get Tom on the board, because he asks if the premium really is just about $5 a month, why would we not do it? And he put "not" in capital letters. I hear what you're saying, Tom, but you know, $2 here, $5 here, you know, this is earthquake insurance. And it might be somebody else wants a tree replaced and might have damage to lawns. We nickel and dime these things. And if we can find $2 to $5 a month on certain things to save money, it really makes a difference in whether or not a budget gets ratified, whether or not the populace is happy with the dues. It's a whole thing. I hear what you're saying. I'm making light of it a little bit. But we have to look at cost savings as a board across the board. And that's why. I hope that helps to answer your question. Why would
It
we
does,
not?
thank you. Yeah, thank you.
Yeah.
I did like quick math. So at the current, like you have earthquake coverage currently at the moment, and it's $5,100 annually. So if you divide that by the 350 owners that you have currently, it's about $14 a year or $1.18 per month currently.
All right. Anybody else have anything before we finish? Okay. Well, I'd love to thank Ryan for coming out and doing this.
Yeah.
We appreciate it.
Yeah.
And I really appreciate the 25 or so of you that showed up to help us as a board make a decision and listen to this and to be informed. It makes a big difference. Thank you.
Agreed. Thank you.
You are welcome.
Take care, everybody.
All right.
Thanks, Ryan.
You're welcome. See ya.
Bye.